Hello everyone. So in last session we have learned about what are the transactions between a partnership firm and a partner. So we have seen the transactions between the partnership firm and partner are interest on capital, interest on drawings, then loan from partner, okay, loan to partner, interest on loan by partner, interest on loan to partner, then we have seen partner's salary, partner's commission, okay, then rent payable to the partner. Okay, so now in this session we will be learning about how to pass a journal entries for all those transactions. Let us understand that. So there are two things, one is adjusting entry, one is closing entry or a transfer entry. Okay, now closing entry and transfer entry will be passed at the end of the year. So for now we will be learning about what is the adjusting entry, that is what is the initial entry that we need to pass for each and every transaction. Now first was interest on capital. So interest on capital is given by firm to partners. Now we are in the books of firm. Remember, we are in the books of firm. So now see here, what did we write? Interest on capital is like expense to apply debit credit rules. So for applying debit credit rules, you have to treat interest on capital like an expense. Now let us see what is the adjusting entry for interest on capital. So adjusting entry. So what are the two accounts that are affected over here? One is interest on capital. Now I am writing it in the short form. You should write interest on capital in exam and in the book also. Okay, don't write it as IOC and all that. Now this is one account which is affected, and now we have to give this interest on capital to partners. So the second account that will be affected is partners capital account or current account. Now see here, what is a current account? We will learn about what is a current account later, but for now, for understanding a journal entry, understand that current account is like a capital account only. You have to treat current account like a capital account only for the purpose of journal entry. So now interest on capital. So what are the journal entry rules in case of asset? Expenses: increase debit, decrease credit. In case of liability and income, increase credit, decrease debit. Now interest on capital is like an expense, correct? There is an increase because firm's interest on capital is increasing. They have to pay it to the partner, correct? So balance in interest on capital will increase, so it is increasing, so debit. Now partners current and capital account, both I told you, right? Current account also you have to treat like a capital account only. So it is a liability, it's an internal liability from firm's point of view. Now whenever we are paying a interest, okay, so we have to give it to the partners, correct? So this interest, the firm owes this interest to the partners. So the firm's liability towards the partner is increasing. So we have to credit. So journal entry for this will be interest on capital account debit to partners capital account or current account. We will see what is a current account later on. Okay, just write this. So next is interest on drawing. So what did we learn about interest on drawing? So partner has a drawing, that is withdraw some amount from the firm, okay, on time to time basis. Okay, now firm is charging interest on drawings from the partner. So this interest on drawings is to be paid by partner to firm. So if it is paid by partner to firm, then firm is receiving it. So we have to treat it like income. So let us understand the journal entry. Now one thing that we learned, that is withdrawal of capital is not drawings. We have already discussed this point in the previous session. Okay, now let us understand the journal entry over here. So what are the two accounts that are affected? Interest on drawings, and since interest on drawing is to be received from the partner, okay, we have to consider partners capital account or current account. Okay, now interest on drawings is like an income for the firm. So interest on drawing balance is increasing, so we have to credit it. Now we have to recover this interest on drawing from partners capital and current account. So this is an internal liability. So for the purpose of debit credit rule, it's a liability. So when we take this from the partner, the balance in the liability account will be decreasing because we have to recover this from the partner. So if the liability is decreasing, then debit. Understand this thing. When the firm's liability towards partner decreases, we have to debit. When the firm's liability towards partner increases, we have to credit capital or current account. So now what is the entry over here? Partners capital or current account debit to interest on drawings account. Okay, so this is known as a adjusting entry. So there will be a question wherein they'll ask you to pass a adjusting entry. So in this case you have to pass this entry. This is a adjusting entry. Now as I told you, closing entry for each and every transaction we will discuss it later because closing entry is passed at the end of the year. Okay, just write this, then let's move to the next transaction. So the next transaction is loan to partner and interest on loan to partner. So what is happening? What is loan to partner? Firm is giving loan to the partner. So this loan which is given by firm to the partner, from firm's point of view, it's an asset. Okay, and interest on loan has to be given from partner to firm. So partner will give this interest on loan to firm. So this interest on loan is an income for the firm. Okay, so let's see the journal entries for this. So first journal entry is for the loan. Okay, first journal entry is for the loan. So now what are the accounts affected over here? Loan to partner. One is loan to partner account. Correct? I told you loan to partner is a asset account because firm is giving the loan and partner will repay it in the future. Asset account, and the other account that will be affected is, see, you are giving loan either in cash or bank. So cash or bank is also an asset account. Loan to partner asset, this balance is increasing, so we have to debit it. Cash or bank balance will be decreasing, it's an asset, so we have to credit it. So journal entry will be loan to partner account debit to cash or bank account. Okay, so this is the entry for loan to partner. Okay, now second journal entry will be for interest on loan to partner. Now see, this interest on loan to partner is received by the firm, correct? So it is like an income. Okay, now understand this thing. See, interest on loan has to be recovered from the partner, correct? So what we will do is we will recover it from partners capital or current account. Okay, this is very important. This is little different. Okay, so we will recover it from partner's capital or current account. Now what is happening? Interest on loan to partner is an income. It is increasing, so we have to credit it. Now recover means we have to take it from the partner. That is, firm has to take it from the partner. So the balance in the capital or current account will decrease, correct? Firm's liability toward partner will decrease. So we have to debit. So the journal entry will be partners capital or current account debit to interest on loan to partner account. Now let's say if we have received interest on loan to partner, we have received this interest from the partner, then what will be the entry? See, your cash or bank balance will go up, it's an asset, so debit. and we have received it from the partner. So your partner's capital or current account will be credited. Why? Because we have already charged it in partner's capital and current account. So now we had already reduced this balance from partner's capital and current account, but partner is paying it. So if he is paying it, we just have to increase the partner's capital or current account balance again. So the journal entry will be cash or bank account debit to partner's capital or current account. Okay, did you understand this? Any doubts here? Okay, just write this, then we will go to the next one. Okay, next one is loan by partner and interest on loan by partner. So loan by partner means partner has given a loan to the firm. So for firm it is a liability, and interest on loan is given by firm to partner. So that interest on loan is the expense. Okay, interest on loan is an expense for the firm. So now let us see the journal entry over here. So first will be a loan entry. Okay, so loan by partner. So firm has taken a loan from partner. It is a liability. Correct. And loan may be taken in cash and bank. So cash and bank is an asset. Correct. So now liability balance is increasing because firm has taken a loan. So it will be credit. Asset increased because we will get those amount of loan in either in cash box or in your bank account. So asset account increased. So we have to debit. So journal entry will be cash or bank account debit to loan by partner account. In case of repayment of loan, the entry will be reversed because our liability is going down, and your cash bank balance will also go down because you are repaying that loan to the partner. So the entry will be loan by partner account debit to cash and bank. So you can just write here reverse entry on repayment just for your reference, and make a cloud. Okay. So second entry is interest on loan. So interest on loan, if the interest on loan is paid, then what are the two accounts that are affected? Interest on loan by partner. Okay, and second is it is paid. So cash and bank account. So now interest on loan by partner is a expense increasing. So debit. Cash and bank is an asset. We are paying it. So balance has come down. So credit. So the journal entry will be interest on loan by partner account debit to cash or bank account. Okay. Any doubts here? Is this clear? This is very easy, right? We have already done this in 11th standard. Normal debit credit rules I am applying to pass a journal entry. Now the third one. Let's say if the interest is not paid or it is payable. Okay, then what is the journal entry? Interest on loan by partner. Okay, it's an expense, and what we are going to do is it is payable. So we will be creating a liability account. So it will be either outstanding interest account, okay, or we will just add it to loan by partner account. Okay, so this is a liability account. Now what is happening over here? Expense increasing, debit, liability balance on the loan account will increase, outstanding interest is also a liability, increase, so credit. So your journal entry will be interest on loan by partner account debit to, either you will write outstanding interest account, that is create a separate liability account, or you can just add it to loan by partner account, because loan by partner just add the interest. Okay, both the approaches are correct. Now understand this thing. See, here when the interest is payable, we have directly considered it as a outstanding interest account, or we have considered it in loan by partner account. We did not take it in the capital account. We are not crediting partner's capital or current account in this case. But in the above case, okay, in this case, what we have done is, when that interest is recoverable by the from the partner, okay, what we have done, we have debited the partner's capital or current account. Same thing we are not going to do here. Remember this. Okay, so this you can highlight. This is little different. We are creating a separate liability account. You can write not partner's capital or current account. Okay, so the entry, journal entry changes depending on the type of loan, whether the loan is taken by the firm, okay, from partner, or loan is given to the partner. Okay, so don't get confused. Understand this very properly. Understand this clearly. Okay, don't get it confused. Okay, just write this. Then we will go to the next one. Next one is rent paid to partners or rent payable to partners. So in this case, what is happening? Rent is either paid to partners or rent is payable to the partners. Okay, so some office building or anything belonging to partner is taken on a lease by firm, and firm has to pay rent to the partner. Okay, now paying a rent is an expense for the firm. Correct? So let us understand a journal entry over here. So first is, if the rent is paid. Okay, so what are the accounts affected? One is rent account. Okay, this is an expense account. And since it is paid, the second account affected is your cash and bank account. It is an asset account. Okay, so rent is an expense. There is an increase in the expense because we are paying the rent. Correct? Increase in the balance in the rent account. So we will debit it. Cash and bank is an asset, decrease in the balance because rent is paid, so credit it. So the journal entry will be rent account debit to cash or bank account. Did you understand this? Any doubts here? Okay. Now, second is payable. Rent is not yet paid, it is payable. So what are the two accounts affected? One is rent account and one more is outstanding rent account. OS is for outstanding. Outstanding. You can write the complete word. So rent account is an expense account. Correct. Balance in the rent account is increasing because we are paying the rent. Correct. That expense is increasing. So we have to debit. Outstanding is a liability account. So balance in the liability account is also increasing. So we have to credit. So your journal entry will be rent account debit to outstanding rent account. Normal outstanding rent account entry, whatever we used to pass it in 11th standard. Now see here, for outstanding rent also, understand this clearly. Okay. We are not considering partner's capital or current account. Okay. Even though this rent is payable to partner, we are not considering partner's capital or current account over here. Okay. But as per ICSE guidelines, ISC guidelines, what they are saying is, instead of outstanding rent account, you credit it to partner's capital or current account. So rent entry for ISC will be rent account debit to partner's capital or current account. See, finally outstanding rent has to be paid to partners. But here in CBSE, what we are doing it, we are keeping it separate in outstanding rent account. So two entries. One is this outstanding rent and one is for the interest on loan by partner. Okay, we are not crediting or affecting partners capital or current account. Here also we are crediting it to a separate liability account, or you can add it to loan by partner account. Whereas here also we are doing the same thing, but same is not the case for ISC. In ISC, instead of rent, outstanding rent, we will write it as to partners capital or current account. Only for rent, okay. Interest on loan by partner, it's similar. Here rent, the treatment is different. Did you understand this? Any doubts here? Okay, just write this. Then we will go to the next one. So whatever clouds and everything I am doing, just do it in the same way. Use the color pens, okay. So what will happen is, whenever you are reading the notes, okay, if you highlight certain things, okay, it's easy to recollect it and revise it when you are reading the notes. Okay. So those who are CBSE students, just write it outstanding rent. Those who are ICSE, instead of outstanding rent account, write it as partner's capital or current account. Next, partner's salary. So what is happening in partner's salary? Firm is paying salary to partner. Now partner's salary we have already written, it is like expense. Okay, so let us see what are the accounts that are affected for the journal entry. So we are going to pass adjusting entry. Okay. Okay, so what are the accounts that are affected? One is partner's salary. It is like expense for the purpose of debit credit rule. And second account that will be affected, see, we are giving this salary to partner, correct? So second account that is affected is partner's capital or current account. So this is a liability, internal liability for the firm, correct? So what is happening? Expense, partner's salary expense is increasing, correct? Because we are incurring this, firm is incurring this, so we have to debit. Now it is payable to the partners, so partners capital and current account balance will also increase, correct? So we have to credit it. So the journal entry will be partners salary account debit to partners capital or current account. Okay, so this is a adjusting entry. This is known as a adjusting entry. So just write this, then we will go to the next one. Next, partners commission. So partners commission is again paid by firm to partners. Okay, it is like expense for debit credit rule. So understand the journal entry for this. So adjusting entry. So what are the accounts affected? One is partners commission. It is an expense. And the second account affected, see, it is to be given to partners. So partners capital or current account. It is again a liability for the firm, internal liability. So see here, this is an expense account, partners commission, balance is increasing, so we have to debit it. Now partners capital or current account, we have to give it to the partner, that is firm has to give it. So liability towards partner is increasing, so credit it. So the journal entry will be partners commission account debit to partners capital or current account. Okay, any doubts here? Yes, no? Okay, now understand this thing, whatever transactions that we have seen between partnership firm and partner, out of that everything we have adjusted it in partners capital or current account. That is the reason it is known as a adjusting entry, except for two entries. What are those two entries? One is rent payable to the partner. We have taken it to outstanding rent account separately. We did not adjust it in partners capital or current account. Again, as per ISC, you can adjust it with partners capital and current account as per ISC guidelines. Okay, So both the approaches are fine, but since we are following as per CBSE, you have to take it separately in outstanding rent account. Okay. Now second is interest on loan by partner. So when the partner has given a loan to the firm, interest payable on that loan, either you add it to loan by partner account or you create a separate liability as outstanding interest on loan. You will not adjust it with partner's capital or current account. Except for those two transactions, rest of the transactions whatever we have seen, that is interest on capital, interest on drawings, then interest on loan to partner, then partner's salary, partner's commission, everything, for everything we have adjusted it in partner's capital or current account. And remember one thing, when the firm's liability towards partner increases, that capital or current account will be credited. When the firm's liability towards partner decreases, that is if firm has to recover something from the partner, then that partner's capital or current account will be debited. Now everywhere we have seen capital account, capital account, current account. Now let us understand what is a current account. Okay, so first you finish this, then we will see. Okay, so let us understand this concept of fixed capital or fluctuating capital. So these are the methods, okay, methods in which the firm may have its capital. So there are basically two methods, fixed capital method and fluctuating capital method. Okay, so now let us first understand fluctuating capital method. Now fluctuating capital method means you will have only one capital account and all the transactions related to partner are posted in the capital account only. So the balance in the capital account will keep on fluctuating, changing. Correct? Fluctuating means changing. That is the reason it is known as a fluctuating capital account. So only one capital account. So this is what we have done it in last year also. In 11th standard, when we learned sole proprietary, we have learned about this fluctuating capital method, wherein there was only one capital account and all the entries like profit sharing and everything was done in the capital account only. So what are the entries in the capital account? Everything, your additional capital, drawings, interest on drawings, interest on capital. Okay, then in this case partner's salary, partner's commission, then you have interest on loan to partner. So everything will be debited or credited to one single account, that is partner's capital account. So that is known as a fluctuating method, fluctuating capital method. Now let us understand what is a fixed capital method. Okay, so in the fixed capital method, as the name itself suggests, your capital will not fluctuate much. Okay, it will remain fixed. Okay, then what will I do about all these entries like interest on drawing, interest on capital? So in this case what happens is there are two accounts that are maintained. So one is capital account and one is current account. Okay, understand this carefully. So in capital account you will only record the transactions of additional capital and withdrawal of capital, not drawings. Remember, withdrawal of capital. So whatever transactions are causing a long-term effect in the capital account, okay, will go to your capital account, whereas all the other transactions other than this will be recorded in the current account. So what all transactions will come here? Drawings, then interest on drawings, interest on capital, partner's salary, then partner's commission, Okay, then interest on loan to partner. So all other entries will come in current account, and in capital account only additional capital if introduced by partner or withdrawal of capital. So I told you, right, withdrawal of capital is permanent, whereas drawings are regular, wherein partner is taking out some amount, okay, out of his capital account for meeting his day-to-day expenses like interest on capital, partner salary. He will keep on withdrawing those amount regularly. So those are drawings. Whereas withdrawal of capital is actual investment in the firms needs to be reduced, and that time that capital will be permanently withdrawn by the partner. Okay, we have already discussed this in detail in previous sessions. So now just write this down. Okay, now in case of your fixed capital method, your capital account will have credit balance. Okay, will have a credit balance, whereas your current account may have both credit or debit balance also sometimes. Okay, understand this. Okay, so capital will have a credit balance and current account may have a credit or debit balance also in fixed capital method. In fluctuating capital method, it will usually have a credit balance, okay, but rarely it can be debit also. So usually have a credit balance, but here it will always have a credit balance. Okay, just write this. Okay, now let us understand what is the format of capital and current account under fixed capital method. Okay, what will be the format of capital and current account in fixed capital method? So you will have by balance brought down. Okay, this is nothing but opening balance. Opening balance of capital account. Then you will have closing balance, to balance carried down. So this is a closing balance. Correct? Then if additional capital is introduced, then your entry will be cash and bank account debit to capital account. So here by cash or bank account, this is for additional capital. Okay, and if there is some withdrawal of capital, okay, withdrawal of capital, then your entry will be capital account to cash or bank account. This is for withdrawal of capital. So if you see, only 4 transactions, opening balance, closing balance will be there, and additional capital and withdrawal of capital will be there in capital account under fixed capital method. And then in your current account you will have everything. So if it has a debit opening balance, then to balance brought down on debit side. If it is a credit balance, then by balance brought down. Okay, so this is nothing but opening balance. Both are opening balance. Correct. Now apart from this, all other transactions will come over here. Okay, for example, if you are giving some salary to the partner, then it will be by partner's salary account, by partner's commission account. Correct. Then by interest on capital account. Okay, now on debit side you will have drawings. If there are some drawings, it will come over here. See, withdrawal of capital has gone to capital account. This is drawings, and withdrawal of capital is over here. Understand the difference. You should know the format of capital and current account thoroughly. okay, in this chapter, because there will be questions wherein they will ask you to prepare capital and current account. So you should know the format of this thoroughly. Okay, and if you see, what we are doing is we are preparing a combined capital account of all the partners. So that will save us time in writing and posting the entries. Okay, because the nature of transactions in the capital account will be similar for all the partners, that is salary given to partners, partners commission. So what we are doing is we are preparing a combined ledger account for all the partners. Okay, now on debit side we have to recover interest on drawings also. Then if there is some loan given to partner, then interest on loan to partner will also come over here. Okay, then what we need to do is we will close it. Then here will be to balance carried down by balance carried down. Okay, now this is, if it is a opening credit balance, it will come over here, correct? Closing balance will come over here. Otherwise, if it is a opening debit balance, then closing balance will come over here, correct? This will go over here, this will go over here. So this is a format. Just write down this format. Done. So now tell me, have we covered all the transactions over here, or anything is missing? Anything is missing? Just think and tell me. Think and tell me if anything is missing. Yes. So your profit of the firm needs to be distributed to the partner. So if there is a profit, you will be giving it to partner, so it will come on the credit side. So we will write by P&L appropriation account for profit. Now what is P&L appropriation account? We know what is a P&L account, we prepared it last year, but what is a P&L appropriation account, we don't know. That we will understand it later on. Okay, for now you can just write it as by P&L appropriation account for profit, and if there is a loss, of course it will come over here to P&L appropriation account. This will be for loss. Okay, so just finish this, then let's go to the next one. Okay, now let us understand what is the format of capital account under fluctuating method. So fluctuating method means what? We have only one capital account and all the entries will come in that particular capital account. So let us just write it. Okay, so by balance brought down, this is for opening balance. Very rarely you will have a debit side opening balance. So if it is a debit side, then it will come over here. Very rarely, huh? You can write it along with me. It is nothing but combination of capital and current account, whatever we prepared. Okay, format we prepared in the last method, that is fixed capital method. This is just a combined account because there is only one account. Okay, then you have by partner's salary, by partner's commission, okay, then by interest on capital. Then if there is additional capital, cash and bank account debit to partner's capital, so by cash or bank account. This is for additional capital. Then what else do you have on the credit side? Yes, by P&L appropriation account, share of profit. Profit, correct? Now let's go to the debit side. In debit side, what you will have? You will have withdrawal of capital, if any. So to cash or bank account, withdrawal of capital. Then you may have drawings. So 2 drawings. Now remember, for drawings now, whenever there are drawings, okay, goods withdrawn by partner for personal use or cash withdrawn, okay, what we will do is we will pass an entry wherein we will transfer all those drawings in one single account, that is drawings account. Okay, and then at the end of year we will transfer it from drawings account to partners capital account. Okay, whereas for withdrawal of capital we will be directly debiting it to capital account. Understand the difference. Okay, then you will have 2 interest on drawings, then 2 interest on loan to partner, correct? Then 2 P&L appropriation account, this is for loss. Okay, so once this is done, what you will do? You will close this, and if there is some other transaction, that will also come over here, transaction between partner and firm, correct? Then you will close this, and then you will have by balance carried down or to balance carried down. So this is nothing but closing balance. Okay, now let us again go back to, now you have understood what is a current account and what is a capital account. So understand this thing. So whenever you have in the question they will be giving you whether it's a fixed capital method or fluctuating capital method. If in the question they have given you that it's a fixed capital method, then all those entries of interest on capital, interest on drawing, then partner's commission, partner's salary, etc. will go to your current account, partner's current account. Otherwise, if they have not given you anything, then you can assume that it's a fluctuating capital method and you can transfer it to partner's capital account. Okay, clear? No doubts here? Okay, now let us go back to transaction between a firm and a partner. Okay, and let us learn on how to calculate all the things, that is interest on capital, interest on drawings. Okay, now here we will be learning about how to calculate interest on capital. So interest on capital is calculated on time basis. Time basis means proportionate basis. Okay, proportionate basis. If additional capital or withdrawal of capital is not given, then it is calculated directly on opening balance. This is important. So interest on drawings will be calculated on opening balance if additional capital or withdrawal of capital is not given. So understand, this is a withdrawal of capital, this is not drawings. Okay, so if drawings are given, we should not consider it over here while calculating interest on capital, because we are charging separate interest on drawings. Okay, so drawing should not be considered over here, only withdrawal of capital should be considered. So that is the reason you should understand difference between withdrawal of capital and drawings. Now how will I know that? In your practical purpose, obviously you will have many analysis and research to understand whether it's a withdrawal of capital or drawing. In question they will be giving you. Okay, so you can just write it over here. Withdrawal of capital is considered but not drawings, as interest on drawings is charged separately. Okay, so while calculating interest on capital, we will be considering only withdrawal of capital and not drawings. Now how will we consider it? What will we do? We will see it. Okay, how to calculate it, we will see it. Just write down this point. Now third point, when the opening balance is missing, okay, so if the opening balance is not given, they have given you closing balance and other transactions. So what we need to do, we need to prepare a capital account, okay, and then calculate the opening balance, because interest on capital is calculated on the opening balance. So first calculate the opening balance and then interest on capital. Okay. Now let us see the example. Example 1 over here. So on 1st April 2024, capital of X is 5 lakhs. Find the interest on capital at 10% per annum. So understand this. So as I told you, capital interest on capital will be on time basis. So on 1st April 24, balance of the capital was 5 lakhs. So this is the opening balance. We have to calculate the interest on capital as on 31st March 25. Okay, now if you see, this capital, opening balance of capital was there throughout the year. Correct? It was there for 1 year, or I can say 12 months. So my interest on capital will be 5 lakhs into rate, that is 10%. So 10 by 100. Now it was there for 12 months. So I have to calculate it for 12 months only. It is per annum. So if it is there for entire year, the interest is 10%. So it comes to 50,000. Okay. Just copy this. Then let's go to example number 2. Okay. Example number 2. On 1st April 2024, capital of X is 5 lakhs. 31st July 2024, there is a withdrawal of capital. This is not drawings, this is withdrawal of capital, is rupees 1 lakh. On 31st Jan 2025, additional capital of 2 lakh was introduced. Okay, we have to find interest on capital. Okay, now let us calculate the interest on capital over here. So let us make a timeline over here. So this is my timeline. Okay, so we are on 1st April 24. Correct? On 1st April 24, capital balance was how much? 5 lakhs. Let me write it over here. Then what has happened? On 31st July 24, there is a withdrawal of capital of 1 lakh. So on 31st July 24, withdrawal of capital will reduce my balance of capital. So 5 lakhs was the initial balance minus 1 lakh. So my balance of the capital will be 4 lakhs. Okay. Next, 31st Jan 2025, additional capital was 2 lakhs. So 31st Jan 2025, additional capital was 2 lakhs over here. So let me write it, 31st Jan 25. What was my earlier balance? 4 lakhs. I'll write this down. Additional capital plus 2 lakhs. So my balance in the capital account is 6 lakhs. And this is my year end. Okay. Now understand this. The balance of 5 lakhs. The balance of 5 lakhs was there from 1st April to 31st July. So it was there for month of April, May, June and July also, because this is 31st July. Okay, so it was there in the month of July also. Entire 5 lakhs was there in the month of July. Only on the last day it has changed. So July will be 5 lakhs only. Okay. Now balance of 4 lakhs was there from 31st July to 31st Jan. So July we are not considering over here. So full month. So August, September, October, November, December and Jan full, because at the end of Jan it has changed to 6 lakhs. So Jan was also 4 lakhs. Correct? Then from 31st Jan to 31st March it was 6 lakhs. So Feb and March. So now how much do we get over here? See, April, May, June, July. So this is 4 months. 1, 2, 3, 4, 5, 6 months, and this is 2 months. So 4 plus 6 plus 2 is 12. So you should always cross check this. Okay. Now let us see how to calculate interest on capital. So interest on capital has to be calculated on proportionate basis. So from 1st April 24 to 31st July 24, interest on capital will be, see, 5 lakhs was the balance. So 5 lakhs into 10 by 100 into, for how many months? 4. So 4 by 12. Okay. Then from 1st August 24 to 31st Jan 25. Balance was how much? 4 lakhs. So it will be 4 lakhs into 10 by 100 into how many months? 6. 6 by 12. Then Jan to March, correct? That is Feb and March. So I'll consider it as 1st Feb 25 to 31st March 25. It was increased to 6 lakhs. So it will be 6 lakhs into 10 by 100 into 2 by 12. So you should always cross check this. 4 plus 6 plus 2. In case of interest on capital, it should be 12. Unless the business is only started in the middle of the year. Okay, let's say if the business is started somewhere in the June. Okay, then till the end of the year, it is 9 months only. 10 months. Let's say June 1st it has started. Then including June, you will get 10 months. June, July, August, September, October, November, December, Jan, Feb, March, 10 months. So in that case, this total will be 10 months. But usually when it is full year, this total has to be 12. Now calculate this and get the total. So we get 16,667 over here. Here you get 20,000 and here you get 10,000. So total comes to 46,667 is interest on capital. So that is what is said in point number 2, that interest on capital here. Interest on capital is calculated on time basis, and point number 2 is if additional capital or withdrawal of capital is not given, then on the opening balance. That we did it in example 1 here. Additional capital and withdrawal of capital was not given. But when it is given, we have to calculate it on time basis. Okay, did you understand this? Any doubts here? Yes, any doubts? Okay, so we will close for the day. Okay, we will continue with this calculation in the next session.